Hey everyone, Dave Dubeau here with another episode of the Property Profits Real Estate Podcast. Today, zooming in from just over the hills, beautiful Calgary, Alberta, Mr. Pierre-Paul Turgeon. Pierre-Paul, how are you, my friend?
I'm great, Dave. Thank you for having me. And the hills are much bigger than hills, but yeah, let's leave them at hills for now. They're hills in your part of British Columbia.
Well, the Rocky Mountains are mountains pretty much anywhere, except for they're hills compared to the Himalayas, I guess. But
all right.
There we go. So if you're not familiar with Pierre-Paul, he is Canada's #1 go-to guy when it comes to all things. Learning about multifamily investing. He's got the website on it, multifamilyinvestingcanada.com, if I'm not mistaken, Pierre-Paul.
Bang on, yep.
Yeah, and the cool thing is, not only does Pierre-Paul do multifamily investing, but he really understands the numbers inside and out, because that was the field they used to work in very, very exclusively. So, Pierre-Paul, why don't you just very quickly fill in the gaps, and then let's jump in. Let's talk about the multifamily investing landscape in Canada right now as of September of 2021.
Yeah, first thing, Dave, you and I are educators, teachers, right? Anybody can do multifamily. You've done it. I've done it many times, and I've seen many, many people, regular folks, get into the game of multifamily business, right? It's just the limiting beliefs are what prevent people from doing it. So I want people to understand this is for anybody. You do have to have courage and perseverance. I'm not going to say it's easy, but that's the first thing. You know, you don't have to be like myself, a former CMHC apartment building underwriter. So that's the first thing. But in terms of the landscaping current to today, the 7th of September, 2021, Dave, you know, we're still in the pandemic, fourth wave and all of that. Once again, I can tell your listeners in the last year, I saw a repeat of what I saw back in 2008, 2009. That is, apartment buildings outperform most other asset classes that you can invest in. So that's to begin with. I've continued to do well with my own portfolio or my students. And I talk to bankers and mortgage brokers on a regular basis because it's my job. But apartment buildings have fared very well during the pandemic. First of all, the majority of multifamily investors did not have to call on CMHCs if the deal was CMHC insured on the mortgage payment deferral program. Very few multifamily owners recorded or resorted to the mortgage payment deferral. Mm-hmm. Secondly, our tenants kept paying rents at a rate of 96% across Canada. Wow. So, I mean, we weren't able to increase our rents, but, overall, there wasn't an issue. And of course, guess what? The cost of money remains ridiculously cheap. I refinanced one in June. It is CMHC insured. I don't always go CMHC route, but I tend to because it's better, lower interest rate. And I took a 5-year loan term at 2.01%. Wow. It's free money. Yeah. And if you consider the cap rates, particularly in my market, I'm in Edmonton. My portfolio is in Edmonton, but cap rate would be about 5.25%, so 2% interest rate. So I get a nice spread of 3.25% in between. That's what you want. So the sky isn't falling. And Dave, I got to tell you, that's the same thing that was happening back in 2008, 2009, the Great Recession. I was an underwriter still, in multifamily department at CMHC. And this is when I had my big aha moment when I said, "Oh my gosh, people are making so much money. What? Biggest recession since the 30s, and people are still making money with apartment building." That's when I said, when I grow up, I want to be a multifamily owner. Okay?
Quit underwriting these things. Let's start owning some of these things, right?
Well, I knew the writing was on the wall. That was in 2008. So I left in 2010, CMHC. So that's to paint it in a general brush. That would be the state of the multifamily market in Canada. If we go west, we know the West Coast, Vancouver, Lower Mainland, those prices are ridiculously high for apartment buildings and anything above $300,000-$400,000 a door, which is crazy. Higher, core downtown Vancouver. Toronto, it's pretty crazy with cap rates. Sometimes high 2%, 3%, it's crazy. Montreal, a little bit better, but they remain a sound asset. You don't invest over time, like for a short-term, return on investment. So it remains a great asset class to invest in, no doubt.
Well, okay. So why don't we back up a little bit? And why do you think apartments are a superior asset class to invest in versus single family homes, for example? Because, throughout the pandemic, we have seen appreciation in single family homes, I would suggest, outpace apartment buildings, but that's only one of the profit centers. And why is it that you feel that multifamily is a better choice long term?
By far, it is, and I'm glad, and that's something that I'll talk about in one of my masterclass that your subscribers may consider to sign up for when I talk about cap rates. But the big difference, as you know, when you move to the bigger sandbox of 5 or more apartment units or rental units in a building, is called the value of the asset is derived out of the income of the asset, right? And so you have a wealth multiplier effect that kicks in, which doesn't kick in when you buy smaller rental properties, and let's define them 1 to 4 units. So small rental properties, 1 to 4 units, and my stuff is 5 or more units. And so that wealth multiplier is like a ratio depending on the cap rate in your marketplace where you invest, but is somewhere between 1 to 16 or 1 to 25 in a very compressed cap rate market like Vancouver or let's say GTA Toronto. All right. So what I'm saying is your job as an investor is to positively impact income. And if you do so, and we can talk about how we do that, but every dollar that you increase your NOI, your net operating income, translates into an increase in property value of somewhere like $16 to $25, to use my multiplier earlier. That will not happen when you increase the income on a small rental property. You increase the rental income on a small rental property, 1 to 4 unit, you only increase your net cash flow. You don't have the wealth multiplier. But, there's pros and cons, but, you have more flexibility.
That's definitely a big one. Now, also, one of the things that you alluded to was 08, 09. That was the Great Recession, the Great Reset. And what you were noticing was that multifamily investors back then were making a lot of money in spite of what was going on with the economy. So why don't you kind of share your take on multifamily investing in good economies as well as in bad economies?
So that's the pros and cons of multifamily investing. In a bad economy, people tend to shack up together. So they go into apartment buildings. Oftentimes they lose their homes, or something like that. So oftentimes your vacancy risk, Dave, is diluted among more units. The example I always use, if I have a 24-unit building, I have 1 vacant unit in there, I'm still operating at 96% capacity, still paying my mortgage down and still generating an income. So whereas if you got a smaller property, then that doesn't happen. Let's say you have a single home you're renting out. If it's vacant, it's 100% vacancy, right? So that's one thing that really protects you from, in difficult times. It's just a more stable asset in that regard. And also the banks realize that. So financing continues to flow for apartment buildings, versus when things can get tough in smaller rental market, that may not be the case, and especially, and at some point, Dave, as you probably know, when you invest in smaller rental properties, at some point, you're going to reach your max, you're going to max out your TDSR, your total debt service ratio, and the bank say, that's it, we've lent you all the money we can. That doesn't happen with my stuff, or multifamily properties of 5 or more units. As long as you qualify for each loan, which is usually a matter of having sufficient personal net worth, you can borrow as many properties as you want. And again, if you don't have the personal net worth, just let me throw that in there. They find a joint venture partner that does, right? So there's always a problem. There's always a solution to any problem. So,
yeah.
So
one of the big benefits of multifamily is when times are good, it's good. You got a big influx of people coming into the area. They need a place to live. They need a roof over their heads. When times are bad, you're minimizing your risk because it's spread out over multiple units.
Exactly.
Plus, guess what? People still need a place to live, and they tend to need a more affordable place to live. They might be, unfortunately, losing their home or their house or what have you, but they still need somewhere to live. So where are they going to rent? Probably
exactly
an apartment.
And Dave, I want to add to that, right? I'm like me. You're in the real estate world day in, day out, and you just read the media. What home prices have increased by what? The average home price in Canada is $671,000. I mean, that's an average across Canada. It'll be lower depending where the market, but they've gone through the roof since January, something like 27%, something like that, right? Home prices. So we have a housing crisis in Canada. And don't believe the politicians, what they tell you, by the way. I don't want to throw any party in there, Dave, but they can't do nothing. The federal parties can hardly do anything. And that's the challenge that we have. So what I'm saying to you, Dave, is increasingly this country, beautiful country of ours, is moving towards a society of renters like it is in Europe. It's always been in many, many places. So you want to create wealth, you want to create money, you might as well be a landlord, right? A good one, that is, not a slumlord, but there are increasing opportunities in Canada that I see for quite many years to come. So, that's my take on it.
Well, that makes sense. So one thing that kind of threw a wrench in things for some folks were some new rules with CMHC and taking capital out of a deal. Talk to us a little bit about that and how that's affected things.
Yeah. So first of all, CMHC is a crown corporation, and they publish their guidelines or their policies when there are policy changes, whereas conventional lenders, which is the other way you can finance your deals, which is non-CMHC insured financing. All right. So if you go to a private lender or a conventional lender, they can do whatever they want on the spot. You don't know this in advance until you submit your financing application. Whereas at least CMHC, they publish, because they're a crown corporation, they publish their changes. So the biggest change that came, we've had two, and they're quite earth-shattering, I'll say. The first one came, I think it was in July last year, so the onset of the pandemic, about what the uses of equity takeout money. So when you refinance, you recapture a bit of your equity. You used to be, and that's what I saw back in 2008, 2009, people could do whatever they wanted with that money. As a matter of fact, back then, they were taking equity out, buying another apartment building. Values were really much lower at that time. And, so that's what people could do, whatever they wanted with the money that they refinanced and took out of the asset. Now it's restricted. This is specifically for CMHC insured loans. It's restricted to using that equity takeout money for purchasing another property, building one, capital repairs, securing permanent financing if you had a construction loan in place, and certain other uses determined on a case-by-case basis. The one thing that they don't want you to do now with CMHC takeout funds is to pay equity back to investors, okay, to equity holders, which is one of the ways we would pay back our investors, you and I, in the past. This being said, what about enforcing, okay? And I got to be careful because, I talk to people all the time.
Yeah, it's your old boss you're talking about here. Yeah.
Well, old boss and, mortgage brokers, but really, how are they going to enforce that? So that's because CMHC is not set up to enforce that. The lenders are not set up to enforce that necessarily. What it looks like, okay, and nothing is cast in stone. Every lender can do whatever they want. But it looks like at the end of your loan maturity, let's say standard loan, 5-year loan term, which the lender will look at how did you spend that money, right? 5 years from now. I don't know. I don't know if they'll do that or not. I don't know. But that's what I'm told. That's how it's going to be enforced. So that's the first big policy change. You cannot use equity takeout money on a CMHC.
Well, so what is their justification for that? Why did they say that was necessary?
I could read you what they said in their policy advisory, but from the street, it's pure bullshit. Can we talk like this in your podcast? Yeah,
we can now. Yeah,
bullshit. Okay. It's a perception. They were hammered. First of all, interest rates kept dropping, as you remember last year as well. They were swamped with too many refinancing applications, didn't have the staff to do it. But what they say here is because they feel that when you use equity takeout, so you increase the loan amount, take that equity out, pay back your investors. And I'm reading from their policy change. They're considered that an improper use of government resources. Folks, before I was an underwriter, a multifamily underwriter, I was in charge of the default management and real estate department at CMHC for the regional office of Calgary and the Prairie region. Apartment buildings were early default. To this day, I just said that during the last pandemic or previously 2008, 2009. It's a freaking cash call for CMHC. So what? And we pay a premium to get this insurance. So what government resources are you talking about? It's my freaking resources. So anyways, but that's the reason why they've implemented that. I think it's just they're bureaucrats. I was one of them. Forgive me. I didn't know any better, as I wasn't a business person. It's literally apartment buildings are a cash cow for CMHC. They rarely default, and I mean this. Like I used to manage defaults, and I was bored out of my mind. That's why it's transferred over to the multifamily underwriting department. This is no joke. I was literally bored. I had a few social housing projects to manage the default. Otherwise, there were no defaults. There are still no defaults. So
okay, so that's the first thing. What was the second thing?
Second thing came just in January, January started. I think January came into effect January 15th. CMHC never required us to get an appraisal on our deals, whether you purchase or refi. Now, any apartment building between 5 and 24 units, they do require an appraisal. This too is somewhat earth-shattering. The reason being, if you've ever watched any of my videos or my training, CMHC, when you presented a deal to them, they always dinged you on valuation. They always came up with a lower lending value in order to approve a lower loan amount. In other words, that was a means to reduce their risk, right? So by not asking an appraisal, they had no freaking idea what market value was. And so they could arbitrarily use, like I said, a lower lending value to determine what loan they would insure, all right? Which was a freaking pain in the butt for many, many investors that are out there, or myself, not myself, because I always knew the game, how to play it. So, but anyways, I'm in a different kettle of fish altogether. But now, so that means what? The impact of that, I think over time, this is still fairly new, right? It's not even a year-old policy, that over time, hopefully, CMHC will be closer to market value. So as an investor, you're trying to figure out how much financing can I get insured with CMHC? You're going to be able to better estimate, how much financing you're going to get, therefore, how much, down payment you need. And therefore, for guys like you and I that raise capital privately, how much capital we're going to need to raise to have our down payment cover all our closing costs. So that was a big policy change this past year.
So that one's actually positive. Yeah. That's actually a positive policy change for it.
This one, I think so. Time will tell, but I think over time should be a good one. I'm hoping.
Very good.
Yeah, there you go.
All right, Pierre-Paul. So you've got some masterclass trainings coming up over the next couple of months, I believe. We're at the beginning of September right now. Why don't you tell us a little bit about what these masterclass trainings are all about? And then we'll have the link in the show notes, you guys, because it's kind of a big, long, funny-looking thing. So we'll put the link in the show notes if you're interested in finding out about that. If you're listening to this, you can go to propertyprofitspodcast.com and get access to those. So, but tell us about this masterclass series, Pierre-Paul.
So the first masterclass is on September 22nd, Dave, and it's about the magic of cap rates revealed. So exactly the kind of wealth multiplier fruit that we're talking about. But I teach you about how banks think. Like literally when I teach this kind of content, and you're right, I'm very unique in that particular knowledge that I have both as an investor and former insider. So I take you inside the mind of an underwriter and an appraiser, if you will. How do we arrive at a value? Why? Precisely because you can be in a position to argue, whether it's with your vendor, if you're buying, about how the value is arrived at, or with your lender. And I've fought and won battles with my lenders over time because I knew how the game works. So, and cap rates are one of the three valuation approaches that we use, and it's the main one. So I take you behind, the scene, how bankers are looking at this, and CMHC, and always my stuff I teach experientially, which I give a concrete example of the wealth multiplier effect in that masterclass. So that's September 22nd. Second masterclass is on October 6th, and it's attracting capital for your multifamily property. Now, I'm not competing with you, Dave. I cannot beat you. You're the best at this.
No competition, my friend. You're awesome.
No. The law of abundance, right? If you believe in scarcity, you're going to attract scarcity. But the point is, I have a pretty good angle at this again. And let me summarize it the following way. At the end of the day, when you attract capital, like you have been very successful attracting capital from a core group of investors. And the reason is, I know what they want. Really, your prospective investors want the same thing as your banker wants, which is my core area of expertise, i.e., what are the risks in the deal? How can you mitigate them? And when I pitch a deal, this is how I do it. And same difference, I walk through some of the tools, some of the questions that your investors need to answer and you need to answer, and how to pitch a deal. I'm going to give you a cool tool there to do that. So that's on October 6th, always 5 p.m. Mountain time. And then the last one is on October 20th. It's financing your multifamily deals. Again, going behind the scene and the various options that we talked about at a higher level just now whether it's CMHC insured financing or conventional financing, bridge financing and all that, with, again, an example. I want this stuff. I don't want to be just some guy, good-looking guy flapping his jaws in front of people. It's got to be concrete and tangible and usable. So those are the 3 master classes that's on October 20th, Dave. Yeah.
Well, that's fantastic. So you're going to have the 3 of them. We'll have the link in the show notes. You can click there. That'll register you. One click will register you for one registration, I should say, will get you into all 3. So people aren't able to make them live. You're going to have recordings and that kind of stuff.
Absolutely. They're going to get the replays. Absolutely. Yeah.
All right. Very good. So again, the first one's going to be all about the magic of the cap rate and why that's so important for understanding how to value properties, how to make better offers on your properties, what kind of financing you're probably going to be able to get for those properties. Second one's all about where do you get the money, how to raise capital specifically for multifamily projects and deals like this. And again, Pierre-Paul knows his stuff. He's been doing this for years, raised millions of dollars, lots and lots of investors with him in his deals. And then the third is all about the financing. So how to make the banks happy, whether or not you're working with CMHC, but how to get the financing for your deals. So these are all 3 very, very important topics for you to understand, whether you're actively already involved in multifamily investing or you're thinking about getting involved in multifamily investing. Nobody better to teach you this stuff in Canada than this gentleman, Mr. Pierre-Paul Turgeon. So Pierre-Paul, thank you very much, and look forward to hearing your wisdom on these classes.
Fantastic, Dave. Thank you for having me on your podcast. Cheers.
My pleasure. All right, everybody, take care and see you on the next episode. Bye-bye. Well, hey there. Thanks for tuning into the Property Profits podcast. If you like this episode, that's great. Please go ahead and subscribe on iTunes. Give us a good review. That'd be awesome. I appreciate that. And if you're looking to attract investors and raise capital for your deals, then I'm going to invite you to get a complimentary copy of my newest book, right back there. There it is. The Money Partner Formula. You can get a PDF version at investorattractionbook.com. Again, investorattractionbook.com. Take care.